Good afternoon, everyone. Thanks for taking the time to join us this afternoon. I guess the purpose of today's session was to talk about transfer pricing and what it means for you here in the Middle East. So just to introduce myself, my name is Shiraz Khan. I'm the head of tax at Al Tamimi & Company across the Middle East and North Africa. And I'm being joined by my colleague, Yanis Nanos, who deals with transfer pricing. Yanis, if you could just provide a brief introduction about yourself, please.
Hello, everyone. I'm Yanis Nanos. I'm a transfer pricing professional. I have been working in the field of transfer pricing for a number of years. I have experience from Western Europe, and I've been working in the last 4 years in the region where I have been covering clients across the whole Middle East. Thanks, Shiraz.
Thanks, Yanis. So in terms of the agenda for today's session, we're going to start off with an introduction on transfer pricing. What is transfer pricing? What does it mean? Why is it important? We're also going to look at transfer pricing. We're going to touch on it in the context of the OECD base erosion and profit shifting project. Before we move on to discussing the transfer pricing landscape here in the Middle East, so looking at the approach taken in individual jurisdictions, the practices of the tax authorities, and what some of the rules are. Before we wrap up and we touch on some of the key takeaways for today and what you guys should be doing in order to prepare for transfer pricing. And finally, we'll have a Q&A session at the end. Before we begin, just a few housekeeping points. So the session is being recorded, and we plan to share a recording of the session after it ends. The audience is muted, but you will have the opportunity to ask questions through the Q&A function, and we'll aim to answer these questions at the end of the session. There will be some polling questions throughout the actual session, so if you could stay ready and respond to these questions. If you can't hear us, please make sure that you've connected your audio by choosing to either connect through your computer or phone. Okay, so just to start off with, what is transfer pricing and why is it important? Before we do that, a polling question for you. Are you familiar with the concept of transfer pricing? So if you could just answer with a yes or no. I'll just give you a moment to answer. It may be that some of you have heard the term, but don't know what it means. On the other hand, maybe you haven't heard of anything at all. So please feel free. Okay, so we've got 91% yes, which is pretty interesting. I was expecting the number to be actually lower, but that's great. So it means that you'll probably be familiar with some of the basics we're going to discuss in the initial slides. Okay, just to start off with then, what is transfer pricing? If you think about any business transaction, whether you're selling services or you're selling goods, in a typical open market situation, the seller would be trying to maximize the amount they receive for the sale. They want to obviously make as much profit as they can. So their objective is to maximize the price. So you want to increase the price and just get as much as you can from the actual buyer. On the other hand, when you look at it from the buyer's perspective, the buyer is obviously looking for a bargain. They'll want to pay as less as possible. And, so therefore they want to reduce their cost. So you've got these competing objectives in a normal situation where you don't know each other. Both the parties are unrelated. So you've got the buyer who wants to maximize the price. You've got the seller who wants to pay as low as possible. This situation changes when it comes to a group of companies. So in a group of companies, essentially you have a common shareholder. Either someone controls both of you, or one company controls the other company. And in this kind of context, quite often the objectives are not competing. So what the overall objective of the group is to actually minimize the tax liability. And to minimize the tax liability, you could end up in a situation where you actually manipulate the price. So transfer pricing, is relevant when it comes to related party transactions, and it's determining the price when it comes to transactions between related parties. And why is it important? Because, when you have related parties, you can manipulate the price of transactions. For example, you could artificially inflate the expenses, which reduces your profit and therefore the tax you pay on the income. On the other hand, you could actually reduce the revenue. And if you have less revenue, then you have less profit and you pay less tax. And again, how can you do that in this situation? Because you're related parties, and you could actually artificially set the price. So taking an example as we have here, so if you're a group and you have a company in country A, and then you have another company in country B, and the tax rate in country A is 0%, and the tax rate in country B is 20%. And you obviously have two companies and you're part of the same group operating in these two countries. Now, from a group perspective, you want to, has as much profit as possible, and therefore you want to pay as less tax as possible. And because you have 0% tax rate in country A, and you have 20% tax rate in country B, you effectively want to have as much profit as you can in country A because it doesn't have any tax. And in order to do that, any transactions between the company in country A and country B, in a typical situation, you'd want to, effectively maximize the cost in country B and maximize the income in country A. So therefore, you want to inflate. And this is a typical transfer pricing situation where essentially you're a group and you operate in a number of countries, and some countries have lower tax rates than other countries. And you want to effectively shift the profits in countries where there's little or no tax. So therefore, as on a group-wide basis, you pay less tax. So transfer pricing is actually, it deals with this precise situation where it effectively determines the price which you should charge in related party transactions, because there's an acknowledgement that the price can be manipulated. And therefore, transfer pricing, most countries have transfer pricing rules, which is almost like an anti-avoidance rule. It prevents you from avoiding tax by manipulating the prices. And central to this is the concept of arm's length. So when you have a related party transaction, typically speaking, the country will have rules, and they will say that if you're a related party, and it'll define the situation you're a related party. For example, if one company controls the other, sometimes through shareholding, sometimes through voting rights, other times through assets, through winding up, or through any other means, contractually perhaps. And in this type of situation, the transactions between the related parties are required to be on arm's length basis, meaning that you should charge the price which two unrelated parties would charge. So this is the purpose of the transfer pricing rules, to prevent companies from manipulating prices and to make sure that they actually set prices which are in the arm's length range. And quite often you have to not only charge the price which is arm's length price, which depends on you actually doing an exercise and finding out what other companies in your industry or for this particular transaction charge, and then benchmarking, how much should you charge based on your situation. So therefore, you have to keep documentation, which is critical when it comes to transfer pricing, to demonstrate that in this situation where you have related party transactions, you actually, the amount you're charging is arm's length and is supported by documentation. And we'll come on to that later on. So in this particular example, as you could see, in this particular case, the company in country A, if it's selling goods to a company in country B, and it's selling at 250, and the typical market price, which a third party would charge, is 300, of course, they've reduced the price by 50, which would mean that you pay less tax. You only pay tax on 50, essentially. Now, related to transfer pricing is the Peps project. So when the recession happened in 2008, 2009, a lot of countries went into budget deficit. And many of these countries started to focus on how to increase revenues for the particular country. And most countries, they generate revenues and they support public expenditure through taxes. Other countries maybe have more natural resources and are less dependent on taxes. But for most countries, tax is very critical in terms of revenue generation. When all these countries went into budget deficit, they were like, okay, how do we generate additional revenues? And tax obviously became the focus. So there was many multinational organizations which were operating cross borders in many, many different countries. And they were essentially doing what I was saying, effectively shifting profits from high tax jurisdictions into low tax jurisdictions and therefore paying less tax accordingly. So the G20 countries approached the OECD, which is an international body, to actually tackle this tax avoidance through base erosion and profit shifting. So the OECD did an exercise and they recommended 15 action points which countries should implement in order to prevent this base erosion and profit shifting. And 3 of the action points actually focused on transfer pricing. And essentially the focus of these action points, which was action 8, action 9, and action 10, was effectively to align the transfer pricing with value creation. So you effectively have the profits in the location where the value is created and where the value is maintained. Now, as part of this Peps project, countries were also required to consider whether they wanted to be Peps inclusive members. And if you become a Peps inclusive member, you have to actually incorporate or implement 4 minimum standards. And the UAE was a Peps inclusive member, as was many other countries in the actual region. And now, as an offshoot to this initial Peps project, there was a Peps 2 project, which had 2 pillars. Pillar 1 dealt with the allocation of taxing rights, and Pillar 2 introduced a minimum corporate tax 15%. And if effectively your tax rate was less than 15% globally, and you're multinational with consolidated group revenues of more than 750 million euros, in this situation, you'd be subject to tax in other countries. This is one of the main reasons why the UAE introduced corporate tax. It was effectively to honor the commitment under the Pillar 2 and to introduce this tax and tax companies more broadly. And also from a UAE perspective, historically, transfer pricing hasn't been important because there's been a limited corporate tax at the Emirates level, whereas now going forward, starting from 2023, the UAE will have a corporate tax. And because it has a corporate tax, it has there's a need for the UAE to protect its tax base and therefore have transfer pricing rules and make sure that companies based in the UAE are not shifting profits from the UAE to other countries where there's no tax. So initially, corporate tax will be introduced, as you may know, starting from financial year 1 June 2023. For most companies, it'll apply from 1 January 2024 because their financial year starts on the 1st of January. However, once corporate tax does come in, transfer pricing rules will become very important. And therefore, you have to monitor your any intercompany transactions and make sure that they comply with the future transfer pricing requirements in the UAE. And also other countries across the region, they have transfer pricing rules. I mean, more recently, they've been codified into detailed rules and regulations, whereas historically, for a very, very long time, the transfer pricing rules have always been there in the tax law. In Saudi, for example, so the transfer pricing rules and regulations were actually effective for financial years 2018. But even before that, under the tax law, which was issued in 2004, there was a requirement for transactions to be undertaken effectively on an arm's length basis. It's just the detailed rules weren't there in determining whether something is arm's length or not. And the detailed rules and criteria, however, that's obviously been introduced now. And other countries in the region as well, Egypt, Jordan, Qatar, they have transfer pricing rules, which you need to be wary of, and hence this presentation. I'll hand over to Yanis now on who'll talk you through the transfer pricing regulatory landscape here in the Middle East.
Thank you, Shiraz, and thank you for this introduction. So, in terms of the landscape in the Middle East, just to take a step back, basically, when we talk about transfer pricing landscape, we are basically meaning, in terms of documentation, we are meaning three key reports. The first one is the master file, is basically a report that describes the key transactions within a group, as well give some high-level overview of the group and what are the main business activities, as well key intangibles and key financing arrangements. The other key document is the local file. Basically, the local file is a report that presents the main intergroup transactions for a local taxpayer, and as well the country-by-country report that is a qualitative and quantitative report with information on the group around the taxes paid, revenues, etc. So having that in mind, this context, let's discuss now what are the transfer pricing rules in the region. So historically, as you can see as well from this slide, Egypt is one of the countries that had firstly transfer pricing rules in place. From 2018, officially introduced the mandatory preparation and filing of the three-tier documentation approach that I just described previously. Then Saudi Arabia followed as well with a specific transfer pricing regime, again introducing the OECD transfer pricing documentation requirements. Qatar introduced similarly transfer pricing rules in 2019, and the number of executive regulations were published to provide further guidance. Later in June 2021, Jordan as well introduced transfer pricing requirements. So these are the countries, Egypt, Saudi, Qatar, and Jordan, with the most developed transfer pricing regimes in the region. And then we have Bahrain, UAE, and Oman that they follow with. They have adopted country-by-country reporting requirements. And as Shiraz just mentioned previously, UAE has announced that it will introduce corporate tax from 1st of June 2023, and as well that UAE businesses will need to comply with transfer pricing regulation that is most probably going to be in line with the OECD. So having said that, if we can move please to the next slide. Thank you, Shiraz. So on the transfer pricing compliance side, we're going to briefly describe now the key requirements for each country. We're not going to dive in a lot in terms of details, but just to give a brief overview. So as we said, Saudi has implemented transfer pricing documentation requirements. That means local file, master file, country-by-country reporting, and as well TP disclosure and affidavit. These are two additional requirements that can seen in the case of Saudi. So in terms of the local file and the master file, same rules apply. There is a monetary threshold, so it applies to income and mixed taxpayers that they have related party transactions that are above 6 million Saudi riyals. They need to be submitted upon request to ZATCA. However, keep please in mind that you need to indicate on your disclosure form that you have prepared the necessary local file and master file. In terms of country-by-country reporting, this is applicable for groups that they are for 3.2 billion and above of consolidated revenues. The CBCR report needs to be filed within 12 months of the year end. In terms now of the disclosure form and the affidavit, these two documents should be submitted together with the tax return. That means basically 120 days after the end of the fiscal year, and as well, there are no monetary thresholds applicable in the case of the TP disclosure and the affidavit. There are no specific TP penalties in relation to non-compliance with the rules in Saudi, but please keep in mind that the rules as per the Zakat and income tax law may be applicable in the case of non-compliance with the transfer pricing legislation. If we can move to the next slide, please. Thank you. In terms of Egypt, Egypt as well, as we said, has one of basically the oldest transfer pricing regime in the region. Again, has three-tier documentation requirements, local file, master file, and country-by-country reporting. The interesting thing again for Egypt is basically that there are monetary threshold requirements for the preparation of the local file and the master file. it needs to be the total value of the related party transactions above 8 million Egyptian pounds. What we need to keep in mind in Egypt versus Saudi is that there is a mandatory filing requirement in terms of the local file and the master file. So in terms of deadline, they need to file the local file within 2 months after the filing of the tax return. And the master file, it really depends if the group is headquartered in Egypt, then in that case, you need to file your local file together with your master file. And in the case of a foreign group, you need to follow your ultimate parent entity filing date. Now, in terms of CBCR, again, there are dual requirements. So CBCR, Egyptian parent groups with revenues of above 3 billion Egyptian pounds, they need to file the CBCR report 12 months after the end of the fiscal year. And for foreign groups, for foreign subsidiaries that are part of a group, and these groups, they have consolidated revenues of euro 750 million and above, euros, they need to file the CBCR notification within the year that the report relates to. The final requirement is around the transfer pricing disclosure form. The TP disclosure form, it was already part of the income tax return, but what the Egyptian tax authorities have noticed from the past is that not all the taxpayers have been completing that form. So now they made it mandatory. But not only this, the Egyptian tax authorities have introduced penalties. It's the only country in the region that has introduced transfer pricing specific penalties. And these penalties can vary from 1% to 3% on the total value of the intercompany transactions. So with this one, if we can move please to the next country. Thank you, Shiraz. So now in terms of Qatar, the requirements are quite similar to the ones in Saudi. There is a local file requirement, a master file requirement, country by country reporting, and the declaration form. The key difference with Saudi is that there is no need for an affidavit. Again, there are monetary thresholds in place. So for taxpayers with total value of assets greater than or revenues greater than 50 million Qatari riyals, they need to prepare and file a local file and master file. The deadline for this is the 30th of June of the following tax year. We noticed last year that the general tax authorities in Qatar gave an extension up to the end of September. We need still to see if this is applicable for this year. In terms of CBCR, CBCR rules are basically applicable only in the case of Qatari headquartered groups. They need to have consolidated revenues of 3 billion and above. So far, the rules do not apply to non-Qatari headquarter groups. And in terms of the declaration form, again, this should be submitted together with the income tax return. And there is a monetary threshold of 10 million Qatari riyals. So basically, taxpayers with total value of assets or total revenues of above 10 million Qatari riyals need to file the report. There are no specific transfer pricing penalties, but still the penalties as per the income tax law apply as well in the case of Qatar. Siraz, if you can move please to Jordan. Thank you. Jordan is the last of the countries in the region that has officially introduced transfer pricing documentation requirements. So, and the rules are quite similar to the case of Saudi in terms of requirements from the tax authorities. Taxpayers need to prepare a local file, master file, that is basically, they need to have total value of related party transactions above 500,000 Jordanian dinars. They need to file it within 12 months from the end of the fiscal year of concern. And in terms of country by country reporting, this is applicable to all taxpayers in Jordan. Jordanian headquarter groups and non-Jordanian headquarter groups. That is basically the requirement is for applicable in the case of revenues of above 600 million Jordanian dinars. In terms of deadlines, CBCR follows pretty much what is in the other countries. So basically, the report 12 months after the end of the fiscal year, and the notification no later than the last day of the fiscal year to which the report relates to. There is a threshold for the case of the DSP disclosure form that needs to be submitted together with the income tax return. Basically, this form is one describing the related party transactions, the values, the parties involved, etc. So far, there are no rules on, there is an affidavit, basically, so taxpayers need a certificate that their transfer pricing policies in Jordan locally are in line with what has been applied in the group globally. Similar like in the case of Saudi, there is no specified deadline for the affidavit, but we are expecting, as we have seen also from the experience of Saudi, that the affidavit needs to be submitted together with a disclosure form. Next country, please. Thank you, Shiraz. So in case of UAE, as we mentioned before, there is only, from a transfer pricing documentation perspective, there are only country-by-country reporting rules so far. However, we have included as well here the economic substance requirements, because this is the basis for the transfer pricing rules. Effectively, with the economic substance requirements, the UAE tax authorities are requesting from the taxpayers to indicate whether they have significant economic presence in the UAE to perform certain activities. So in terms of requirements, these rules in terms of economic substance are applicable to all UAE companies that undertake or earn income from specific activities that are called relevant activities. This can be like holding, financing, IP holding, etc. In these cases, companies that are performing these activities need to file a notification 6 months after the end of the financial year. And in case there is income generated from these activities, they also need to file a report within 12 months of the relevant financial year. As you can see as well, there are significant penalties with regards to non-compliance, and tax authorities can reach even to the level of suspension or withdrawal of the trade license. Now, in terms of country-by-country reporting, the rules in UAE are similar with the rules in Qatar, meaning basically that it's only applicable to UAE headquartered groups. The CBCR report needs to be filed 12 months after the end of the fiscal year, and then notification within the year that it concerns to. Again, there are significant as well financial penalties in case of non-compliance. With regards now to the remaining parts of the TP documentation, there are no local file or master file requirements yet. What we know is that UAE will introduce corporate tax, will also introduce transfer pricing rules that will follow OECD. Following OECD basically means that you will have to comply with country-by-country reporting, local file and master file at a bare minimum. Now it remains to be seen if UAE will introduce any thresholds like Saudi has done in other countries as well. So basically you need to prepare a local file and master file only if you reach a certain level of intra-group transactions in terms of value. And also it remains to be seen if UAE will also introduce additional requirements like the disclosure form or the affidavit. Siraz, I don't know if you want to add anything else on UAE or on the rest of the things we discussed.
Yeah, I didn't have a whole lot to add, except that the UAE's, of course, announced that corporate tax will be introduced, and so far no draft legislation has been published. As part of the announcement, they have made clear certain measures which will be taken, and these effectively reflect the policy decisions which the UAE took. Now, one of the things that they did say that there was going to be transfer pricing rules, and transactions between related parties are expected to be arm's length. So, I mean, it was always expected that the UAE would have transfer pricing rules within the, I mean, the question is, how do they have it? Whether they'll have separate regulations or initially it'll just be a part of the law. But nevertheless, you know, the outcome will be the same, that, you know, any transactions you have between related parties, they're required to be at arm's length, and you'll have to document the basis on which you computed the price, to support the actual price. And, of course, tax authorities are increasingly focusing on related party transactions. So just the next poll question now. Are you ready to meet your local transfer pricing compliance requirements? And of course, some of you may operate in the UAE and you may have presence in other countries. If you could treat this question as a general question, which is applicable across the region to your operations. So it looks like a lot of you are ready, but some of you are not ready, and most of you are somewhat ready, but perhaps you could do more. Just sharing the results with you. So we're now going to move on to the approach and the practices of the tax authorities in the Middle East, and I'll hand you back over to Yanis.
Thank you, Shiraz, for this. So basically, with this section, we're going to give an overview of what we have seen so far from the tax authorities in the region. What we have noticed in terms of transfer pricing audit environment, what we have noticed the last years is basically that the tax authorities in the region, they have increased the number of TP audits. That is happening because of a number of internal and as well external factors. From internal factors, tax authorities are seeking to increase their tax revenues in order to finance their projects. Another thing as well is that tax authorities are also investing heavily in hiring people in their tax departments, transfer pricing experts that they have the knowledge, and also people they are also conducting extensive trainings to train their existing people with in order to be able to handle transfer pricing audit cases. Another thing we need to keep as well in mind is that transfer pricing rules have been introduced in the region for the last 3-4 years. The tax authorities have already been requesting TP documentation. They have been already collecting data around, as an example, from CBCR, as well local files and master files. So one recommendation to all of our audience is basically to make sure to prepare TP documentation, not only in order to tick the box and file the required documents to the relevant tax authorities, but also they need to see that as their first line of defense. The local file and your master file is your story. So you need to make sure that you convey and you share this story with the tax authorities, and it's up to them then to ask questions and challenge this. Apart from this, also, we need to keep in mind as well that transfer pricing is part of the overall tax framework and the overall tax picture. Whenever you have a transfer pricing adjustment, this can also have an impact on your custom duties as well, or you can have an impact as well on the VAT leakage that you have. So just don't see transfer pricing in isolation. Keep in mind as well that TP is interconnected with other tax developments as well. And also, this increased transfer pricing audit environment has resulted in increased tax adjustments. We have a lot of cases, especially in Saudi and in Egypt, that tax authorities are making significant tax adjustments to the taxable basis of the taxpayer. So the best line of defense for this is to prepare an appropriate transfer pricing documentation and make sure that your transactions are priced on an arm's length basis. Shiraz, if you can move to the next slide. So on this one, we're going to cover the key areas of concerns with regards to the transfer pricing audits. Of course, there are several factors, but there are several areas of concern, but these are like the key ones we have noticed within the region. So to start with, a key area of concern is transactions with entities in low or no tax jurisdictions. This is resulting from the Peps project that tax authorities aim to prevent any cases that they see of base erosion, or whenever there is a profit shifting from a tax jurisdiction to a non-tax jurisdiction. So taxpayers need to keep that in mind. The other area are loss-making companies, especially when these companies are having recurring losses for a number of years. Tax authorities tend to see this, that the reason behind these losses are not business reasons, they are tax reasons or even transfer pricing arrangements. So basically, taxpayers are trying to avoid paying any taxes, and they have been in a loss position. Two other important areas of concerns are as well in relation to royalty and intra-group charges payments. Tax authorities have been challenging not only the deductibility of these expenses from the taxpayers, but also they have been questioning as well the fact that if there is any supporting documentation for these transactions, meaning do the taxpayers receive any benefit out of the use of the intangible? Is any benefit coming from the use of the management services? Are any contractual arrangements as well in place? So all of these are questions that are coming to the tax authorities, and we have seen that coming along. Last but not least are also the financial transactions. Groups need to pay attention on their intra-group funding arrangements, on their intra-group loan arrangements as well. We have seen tax authorities questioning the taxpayers for the interest rates applied, if it's arm's length or not, and if this should deny any interest payment. So with that, Siraj, please, we can move to the next session.
So another poll question, how prepared are you to manage a transfer pricing request from the tax authorities? And the options are well prepared, somewhat prepared, or not prepared at all. So it looks like most of you are somewhat prepared, but some of you are not prepared at all, and very few are well prepared. Now moving on to the key takeaways. So I guess, I mean, as Yanis said, transfer pricing is developing quite fast across the region. And the tax authorities in the region are keen to generate revenue from taxes. And one of the key ways they generate this revenue is through transfer pricing. So that's why there's a lot of focus on transfer pricing in the region. And in particular, the audit activity is increasing, as Yanis mentioned. And the key way the tax authorities actually deal with this is they do an adjustment. If they feel that the price you're not charging is not arm's length, after doing the audit, they'll do an adjustment, and then you'll be required to challenge that adjustment legally through the process, which typically involves appealing to the tax authority first, and then going through external, whether it's the committee structure or the court structure, depending on the country. But I think the key takeaways are that, everyone needs to think about, having a transfer pricing policy in place. And if you don't have a transfer pricing policy, to actually review the policy that you have in place to make sure that it's aligned with your business activities, your model, your business model, and also the local transfer pricing requirements in each country. I think having documentation in place which is robust and defends your position is key. Obviously, this documentation is actually your defense, in terms of supporting the position, whatever position that you've taken, and to make sure that you demonstrate that it's actually on an arm's length basis. So therefore, it's important that you have this documentation in place and your methodology is well thought out. I mean, in a lot of cases where we've seen transfer pricing disputes, the tax authorities do look at the transfer pricing methodology as well. So they look at comparables and they look at even the transfer pricing method you adopted, whether it was the most appropriate or whether you cherry pick the method to have a better transfer pricing result. So all of this is part of the documentation. So first of all, deciding the intercompany transaction and then classifying the transaction from a transfer pricing perspective, and then doing the benchmarking, looking at the functional analysis, looking at the assets, the risks, and just comparing them, and then determining an arm's length range based on what other people are charging. It's also important to look at the OECD developments. As I mentioned, there are 15 action points which are actually moving even as of now. So it's important to look at what transpires with these OECD action points, because it will have an impact on the approach of the authorities in the region and what approach they take. And I think what's very important in the light of the increased activity in terms of transfer pricing audits, it's important to develop an efficient strategy in terms of how would you tackle a transfer pricing audit, and just having everything ready to enable you to defend your position in the event of an audit. And again, a lot of this is, comes from the key takeaways, which I've just talked through just now. So I think at this stage, in terms of being prepared, I think it's important for you to review your intergroup transactions and your business model and identify any transfer pricing risks which may be present, or even opportunities. Maybe you're doing things in an inefficient way and things could be done more efficiently, which creates a better result from you. You also need to develop a transfer pricing policy for all intergroup transactions if you don't have one already. If you have one, in light of the changing tax laws in the region, because historically you have global multinationals, and although they have a global transfer pricing policy, they haven't thought about it for the Middle East. So it's something you need to think about. Or if you already have one which is at the global level, perhaps tailoring it for the Middle East region. And then in terms of implementation, so implementing your transfer pricing policies, preparing, reviewing the intercompany agreements, making sure that they adequately document the related party nature of the transaction, and they don't create any additional risk. And also making sure that all the other supporting documentation is in place, like invoicing and whatever other documents which are there to support the price. And finally, you need to work on your transfer pricing documentation. As Yanis mentioned, in many cases, the requirement is for the document to be current. So you need to make sure, depending on your situation, that you have a master file, you have a local file, you prepare the economic analysis to support the pricing of the transactions. And in some cases where required, like in Saudi, you prepare with the transfer pricing return disclosure form affidavit in Saudi, which is required with the tax return. And then finally, in the case that once you've submitted your return and you're confident and comfortable that, whatever intercompany transactions that took place were on an arm's length basis, and then you've on a self-assessment basis, you've submitted your return and completed all your disclosures. In the event that the tax authority chooses to audit you from a transfer pricing perspective, managing these audits from a tax perspective. And there's also a possibility, and although it's a very early stage in the region, so I don't think this is happening very much, but going forward, certainly, I think it'll happen a lot more, because in some of the other more sophisticated jurisdictions for transfer pricing, it's possible that you enter into an agreement with the tax authority in advance, and it's called an advanced pricing agreement. So essentially what you do is you go to the tax authority, you discuss the transactions, and then you agree with them the transfer pricing approach you would take, which is accepted by the tax authority. The benefit of this is that it'll give you certainty upfront, so you know exactly what you're dealing with and what the situation would be. And obviously, if you comply with the agreement, then essentially you shouldn't be subjected to any additional tax as a result of your related party transactions. And sometimes in complex situations, this is advisable. So these are some of the services we're offering for transfer pricing. And so we'll obviously share a copy of these slides after the session, and you could feel free to look through this. So just moving on to the Q&A now. I'll just look through some of the questions that were asked. Yanis, there's a question here for Qatar. Do these rules extend to QFC entities as well?
Thank you, Shiraz. That's a very good question, by the way, and I commonly have seen that for Qatari clients as well. Yes, the rules, I can say that they're applicable as well in the case of QFC. There are no exceptions. And the rules as well in Qatar are applicable in the case of domestic and transactions with across border as well.
The only difference is in Qatar, you have the Qatar, main Qatar, and then you have the QFC, which is obviously a free zone. So the QFC free zone has its own tax and regulations, and they also have transfer pricing regulations. So yeah, transfer pricing is also applicable to QFC entities, but under a different framework. There's another question here. Okay. There's another question here in terms of how about free zone Jabal Ali? Will it be subject to the same TB and corporate tax rates rules?
I can take this on, Siraz,
Sure.
if that's okay with you.
Sure.
So basically, I think, and this is one of the loopholes for the corporate tax regime, the upcoming in the UAE. Even if you don't have to pay any taxes in the free zone entities, it doesn't mean that these entities will not have to comply first and foremost with the arm's length principle, because if they don't comply with the arm's length principle, then you are creating a Trojan horse within the UAE to allocate taxable income from onshore entities to offshore entities. In that case, we are expecting that the transfer pricing rules will apply in the case of the free zone entities. They may not have to prepare transfer pricing documentation as such, like local file or etc. However, the transactions happening between onshore and offshore entities, they should be priced on an arm's length basis. Siraz, I don't know if you want to add anything else on this.
No, it's fine. Now, obviously, the legislation hasn't been published yet. Well, we know that there will be transfer pricing rules, and we also know that the free zones will have special treatment. It's effectively all free zone companies will be required to register and file a tax return, but the exemptions which are currently available will be preserved. So it'll be interesting to see, in terms of how the rules will work from a transfer pricing perspective, because to the extent that you're shifting profits from the mainland into the free zones, obviously, I expect the transfer pricing rules to apply. Okay, there's a question here, Yanis. How does transfer pricing interact with withholding tax? There's a cost plus 5% service between two Middle East entities. The service provider will make a loss after considering 10 to 20% withholding tax they suffer. Do the tax authorities accept this loss?
Yeah, I mean, that's a very good point here that basically in the case of, withholding taxes or any other taxes, you need basically foremost, you need to make sure that your transactions are priced on an arm's length basis. So whenever they are priced on an arm's length basis, then you can also see what will be the withholding tax impact of that specific transaction.
Yeah, quite often where you have a related party transaction, and obviously one company is making a payment and withholding tax is applicable. On the one hand, you've got withholding taxes applicable, but on the other hand, the entity which is making the payment is also entitled to a deduction. So sometimes the rates could be different. I mean, maybe corporate tax has a higher rate than withholding tax, so it still benefits you to have a higher cost and therefore transfer pricing will become relevant as well. Now, there's another question here. How far do these countries accept the OECD low value adding for routine services, cost plus 5% without benchmarking?
That's a very good question. I mean, look, the transfer pricing rules in Saudi, as well in Egypt and in Jordan and in Qatar as well, in the most cases, they follow quite closely the OECD guidance. So for low value adding services, they can basically rely on the guidance from the OECD. However, tax authorities can always ask questions if these services are actually low value added or not. So in most of the cases, we expect taxpayers to have the proper documentation in place to support the nature of these transactions that are basically supportive in nature, etc., as the OECD guidance refers to. And as well, then in that case, they can rely on the guidance from the OECD. Otherwise, it's, I think, the safe choice on this in many cases is basically perform a benchmarking study based on the nature of the services, and then you can identify what is appropriate markup to apply in these cases.
Thanks, Yanis. Just to go through a few more questions, and there's a question here: should the local file and master file be translated into Arabic? The answer is that transfer pricing documentation should be prepared and maintained in English. There's no requirement for Arabic translation, but you know, depending on the requirements, maybe the tax authority will request that at a later stage. But at this stage, there's no requirement for the documents in most countries to be in Arabic. There's a question here, Yanis, on is there a specific format for the local file and master file?
No, there is no specific format. Again, the local file and the master file, they follow the guidance from Chapter 5 from the OECD. So there is nothing really, you know, any difference from that format. The only thing is that in some cases, let's say like in the case of Egypt and as well from Jordan, we see that tax authorities, they have specific requirements with regards to the industry analysis. They are requesting that you know, local industry analysis will be included, as well SWOT analysis, some specifics around the industry participants. So there is some localization, but it's happening only in the terms of the industry analysis.
Sure. And related to that, there's a question that what's the process for submission of local file and master file?
So most of the countries, they have now basically automated the process. So, I mean, apart from Saudi, that basically it is upon request, the submission. You can share this, the taxpayer can share the local file, the master file with Zatka. Egypt has a portal for the filing of, in the case of large and medium tax payers, for the online filing of the local file and the master file. Qatar as well, on Dariba portal, taxpayers will need to electronically file each section separately for each of them sections of the local file and the master file. And Jordan remains to be seen because Jordan has very recently, like 6 months, 8 months ago, introduced transfer pricing documentation requirements. The requirements state that the taxpayers need to file the local file and the master file within 1 year from the end of the fiscal year in concern. So it needs to be seen still what will be the process, if it will be an online process or it will be a hard copy to the tax authorities.
Thanks, Yanis. There's a question here as well. Should the local file and master file be prepared annually? I'll take this question. So essentially, the requirement in these countries, you know, they don't really specify a time frame in terms of when the documentation and for how long it should be maintained, but there is a requirement for the documentation to be contemporaneous. That essentially means that whenever you file the tax return, effectively everything is up to date and current at that time. So effectively, this means on an annual basis, you should prepare the local file and master file and ensure it's updated on an annual basis. There's also a question here, Yanis, on are there any specific local requirements applicable in relation to search for comparables?
Yeah, that's a very common question. We have seen that like many taxpayers asking this before as well. So there are some specifics with regards to Saudi and Egypt. So basically, Saudi is accepting only comparable companies in the searches that are non-loss making. So the Saudi tax authorities, they don't want to see loss making comparables in the searches. It remains to be seen this year with the preparation of the local files and as well the how easy will be to identify these companies, because with the impact of COVID, we have noticed that a significant number of companies has been in a losses for the year before. So it remains to be seen how and if Zatka will accept this. However, in terms of the rule, they should not have any loss-making companies in the comparable search. And this will be also a problem for whenever you have comparable searches and you need to roll forward the results for the next year rather than redoing a new search. Many of these companies will be in a loss position because of COVID. So we expect this to be, they need to be removed from the search. The other specific with regards to the benchmarking studies with the comparable search is in Egypt, that Egypt basically clearly requires in the law to have to conduct, firstly, to look for local comparables, then to expand the search in case you cannot find local comparables, regional comparables, and at the end to end up looking for global comparables if you have not identified significant comparables before. So in these cases, what we end up doing for the case of Egypt, as an example, is basically preparing a regional benchmarking study, because many of the times it's very difficult to identify purely Egyptian comparable companies. So we have comparable companies from all over the region, from the Middle East and as well from North Africa. Yeah, that's basically, there are two specifics I can think about in terms of benchmarking studies in the region.
Great, thanks, Yanis. And there's a question here on the penalties applicable for non-compliance with transfer pricing documentation requirements.
So yeah, so far, I mean, as we also described before, there are penalties in all of the countries but these penalties are coming resulting from the income and the tax law of each specific country. So basically, if you don't file your, as an example, your disclosure form and your affidavit in Saudi, your return will be seen as incomplete. The same case applies as well in countries like Qatar. The only country that has specific transfer pricing penalties is Egypt. In Egypt, the penalties vary from 1% to the total value of the transactions to 3% on the total value of the transactions. This is basically the maximum in terms of penalties. So Egypt has the most stringent regime in terms of transfer pricing penalties.
Sure, thanks, Yanis. And there's another question here. Can we make withholding tax as part of the cost while charging the price to the other subsidiary? Will it be considered an arm's length transaction?
Yeah, that's, I mean, again, it's normally it should not be considered, because whenever you think about from a transfer pricing perspective, you always need to think what two independent parties will negotiate and conclude in terms of pricing. So any other additional cost it should not be considered as part of the transfer pricing margin.
And there's a couple of things here as well. So obviously, withholding tax is a tax on the payment which you're making to the non-resident. Now, effectively, withholding tax is whoever the payer is, they're obviously making the payment for the supply of goods or services. But the withholding tax is intended to be a tax on the non-resident. So it's intended to be a tax on the income which the non-resident is receiving from the payer. So, you know, there's some competing issues there. So it's a tax for the non-resident, whereas the payment is made by the payer. And effectively, because it's a withholding tax, the tax is collected at source at the time of the payment. And that's why it's referred to as a withholding tax. And obviously, in most cases, it's passed on to the non-resident because sometimes the non-resident may have a gross-up clause shifting the tax cost to the actual payer. And there's one final question here. I think we've just gone over time, so I'll just leave it to the last question. I'll make this the last question. If senior and mid-management housed in the UAE are also managing investments abroad together with local business, how will this be viewed in respect of TP if full cost is booked locally?
You mean, okay, so the question is around that there are people here in UAE, but the full cost is booked as well. They manage investments outside UAE, but also within UAE, and how that will be seen in terms of booking of the revenues, right?
Yes.
No, that's, I mean, look, that's, I think it's not only a transfer pricing question, but this has to do as well with, you know, the implication on other taxes as well. And I mean, from a transfer pricing perspective, you always need to think that from what are the functions, assets, and risks performed locally versus what is performed somewhere else. And then depending on the functional profile you have locally, then you should consider what is the appropriate remuneration for these activities performed locally. Now, if there are also you know, other, like there are performed activities for other entities as well, then it should be a consideration of how you should charge out this and cost to the entities that are basically receiving any benefit from these activities.
So thanks, Yanis. I'm conscious that we've gone over time, so we'll conclude the presentation right now, but we will share the slides with you after the session, and we'll also respond to the other questions that we haven't had the chance to respond to during the course of this session. So thank you very much, everyone, for taking the time to attend. I hope the session was productive and useful for you, and please feel free to leave some feedback. And we look forward to hosting you again because we're looking to have a series of different seminars and webinars. So hopefully we look forward to hosting you again. Thank you, everyone.
Thank you, everyone.